Class example 2, differentiate between the risk at the financial statement level and at the assertion level. So the first one, management does not comply with the King Code on corporate governance. They're not complying with the code that tells them how they should conduct their business. It gives me an idea that the control environment is weak. That is a risk at the financial statement level. I can't pinpoint the impact onto a specific balance or transaction, but I can say it gives me an idea about management's attitude. Backup of data in the computer information system does not take place, which means all data in the computer information system could be lost, affecting the entire set of financial statements. I cannot pinpoint a specific balance or transaction for this, it's all of them. A group of companies, we've already looked at that when we said looking at the organizational structure. So this is both, guys, financial statement level and at the assertion level. And at the financial statement level, it's your consolidation. So it's the risk that intercompany are not eliminated. Accounting policies differ of the companies that are going to be consolidated. Related party transactions are not at arm's length and not disclosed. Now guys, related party different to intercompany, hey? Related party, now this could be dealing with a transaction between the company and a director of the subsidiary. So that would still need to be included in the financials. It's not an intercompany, but it might not be at arm's length or disclosed. So make sure you see the difference between related party transaction and intercompany. If it's a related party transaction between the two companies, which makes it intercompany, then it's risk that it's not eliminated, but that's because it's intercompany, not because it's related party. Okay, and then your assertion level risk is your goodwill at the holding company. So risk that goodwill is not calculated right. Goodwill has bias in it, so it's likely to be for valuation, assertion valuation. Management receives bonus based on net profit. We also discussed that one, guys. I'm going to say it's at 2 levels because I can pinpoint the balance, well, not balances, but the class of transactions that are affected by that. It's not any of your account balances. So I can pinpoint where there are going to be risks specific in those financials. So at a financial statement level, it's because it's all of your income and all of your expenses that have the risk. And then at the assertion level, it's about breaking up those income items into, well, it's revenue, it's interest income, it's rental income. And all of these have the risk of being overstated, probably by occurrence, fictitious transactions. And then my expenses, all of my expenses, I break it up into all the different expenses, and they all have the risk of being understated so that net profit is high as possible. Sales manager is under investigation for fraud. Yes, it's a manager, but only the sales manager. So he would have access to revenue. And so this becomes at the assertion level. So it's going to be the occurrence of revenue, fictitious revenue. Import stock from China. The easy one here, when we're dealing with importing, is going to be the assertion level, because you know when they import, there's going to be a translation. So your purchases and your creditors could be misstated in terms of accuracy and valuation. The more tricky one here is the financial statement level, because there will be foreign regulations. And so there's a risk of non-compliance with foreign regulations because they import. Okay, so guys, if you go have a look at the solution here, The only one where I didn't actually, or I changed, is this question or this answer, where I said the bonus based on profit is at the financial statement level. I just went one step further and discussed how it could affect the specific transactions in the financials, because I can limit it just to income and expense. It's different to the control environment because I cannot limit it in the financials to specific areas. It's everything that could be. Whereas bonus based on profits, it's only the items that affect profit that could be misstated for that specific risk. Okay, let's go back to that assertion level.